Hello, my name is Raquel Young and I'm a volunteer with CPA Canada Financial Literacy. I'm pleased to be here with you today to speak about owning your financial future, managing debt and making credit work for you. This program was designed for post-secondary students or individuals encountering debt for the very first time. So let's go have a show of hands. How many of you have a credit card? How many of you have a student loan? And how many of you carry balances on your credit card? It looks to me by the show of hands that many of you have already experienced debt by now. If you were like me as a student, you may have lots of expenses and very little income. You were paying for tuition, rent, books, transportation, and probably had very little income to spend on going out or entertainment purposes. To supplement, you might think about applying for credit cards because they had so many great promotions. Unfortunately, that buy now, pay later motto can lead you into major financial troubles in the future. The importance of staying out of debt seems like a no-brainer. However, based on studies performed by CPA Canada in 2012, they found that 31% of Canadians who borrow money are actually borrowing at higher interest rates than average, and 17% of adults borrow to cover day-to-day expenses. Further, 42% of these adults still owe against these loans. Another study performed by TD Bank in 2011 found that 21% of Canadians only make the minimum monthly payment, and further, 14% regularly pay late fees. I don't think you need to be a CPA to recognize that there is a real problem here. Being smart with your money puts you in control for your financial future. Clearly, Canadians might need some help for financial literacy. That is why CPA Canada is taking a proactive role in teaching Canadians across the country about financial literacy. So what is financial literacy? They are the knowledge, skills, and confidence to make responsible financial decisions at every life stage. As a chartered professional accountant, we are in position to advise individuals and businesses on how to use their money wisely. And hopefully, after this program, you might be interested in other sessions that CPA Canada has to offer. I provided each of you handouts and copies of my presentation so that you don't have to make notes about the details of my presentation. If you have any questions, feel free to ask me either during the presentation, or I will leave a couple minutes at the end of my presentation to take any questions you may have. So without further ado, let's jump into the agenda for the day. We're going to start off by explaining how credit works, how quickly debt can accumulate, the definition that economists call opportunity cost, the classification between good debt and bad debt, what you need to know about credit ratings and how to read a credit report, and then finally, how to take control of your finances before they take control of you. Now, to explain how credit works, we're going to be using the credit card, which I'm sure most of you are already familiar with. Now, so what is a credit card? A credit card is actually a set of promises between the lender and the borrower. The lender is the credit card company who promises to let you use its money when you make a purchase. And so when you go to the store, you can swipe your card and immediately that purchase belongs to you. In return, you as the borrower promise to pay it back, usually at the statement date of the credit card statement. A credit card can be convenient for you, but what's in it for the lender? Well, credit card companies can make money in various ways. The top three are, the first one is processing fees. They make money from charging the store or where you purchased your item anywhere between 1.7 to 3% of the sales price, and further charge more processing fees for a refund if you were unsatisfied with your purchase. The second way that they make money is through annual fees. Now, depending on the type of credit card that you choose, you may be paying an annual fee that covers benefits such as points accumulation, points tracking, and points redemption. And those points could either be used to purchase for travel or merchandise. Depending on the credit card, those also may cover extended warranties or insurance on products that you purchase. And finally, probably the biggest chunk of the revenue comes from interest charges on unpaid items. So do you ever take a look at your credit card statement and in fine print there might be a sentence under your balance called the minimum monthly payment? What is that? Well, the minimum monthly payment to them means that you are fulfilling your end of the bargain per se, but in fact minimum monthly payment could end up causing you to pay more than double your original amount for the purchase that you made. Minimum monthly payments are applied to the newest purchases that you make, leaving older purchases that you purchased earlier to continue to be incurring interest on a compound basis. So what that means is compound interest is charging interest on both your interest portion and the principal portion of your purchase. There's nothing wrong with compound interest per se. If it's working in your favor in your savings account, that's a great thing. That means you're saving money and it's building up very quickly. However, this could be very dangerous territory if you're talking about what you're owing to the credit card company, and those compound interests could be causing your original purchase amount to balloon more than 3 times or more. Let's take an example of a credit card balance of $1,000 with an average interest rate of 20%. They suggest you can make minimum payments of $17 a month. If you follow the credit card company's proposal of paying only $17 a month for their minimum monthly payment, did you know that it will take 238 months or almost 20 years to pay off? So in other words, you'd be paying over $3,000 interest on an original $1,000 loan. That seems ridiculous. By law, credit card companies are required to disclose the information of how long it will take you to pay off your bills. So next time you receive your statement in the mail, make sure you take a look closely for these details because they don't make it too obvious. So let's face it, every dollar spent on paying interest expense could be better off spent elsewhere. The amount of compound interest you're paying is essentially for nothing, even if it seems like a small amount. And as you can see on this chart, those amounts can add up really quick and have a lasting effect. And you just keep losing opportunity to spend that money on other things that are probably more worthwhile for your money. Which brings us to our next point. Economists call this opportunity cost, the benefits you could have received by taking an alternative action. Let's look at an example using $100. Now we'll assume we only have $100 and your resources are finite. You have 2 decisions where you could spend this money. You could buy those expensive pair of jeans you've been eyeing since last season, or you could go all out and go fine dining this weekend to celebrate passing of your exam. Now, opportunity cost says that if you spend your money on buying those pair of jeans, you would have lost the opportunity to go out to celebrate with your family and or other classmates for that great dining experience. Opportunity cost is opportunity lost. So far, we've been focused on credit cards as a source of debt. Let's take a look now at other ways that people take on debt. Unlike popular belief, not all debt is bad debt. In fact, there's 2 categories that we could look at: good debt versus bad debt, one of which the good we expect the asset or the product that you purchase to grow in value over time, and bad debt are those that would lose value over time. So good debt are things such as mortgages or student loans, which we'll talk about in the next slides, which are expected to grow your value over time. Bad debt are things that are consumed immediately and lose value over time, and we'll also go through a few more examples in the next couple slides. So the first example that I think most of you probably already have firsthand experience, if you were like me, is taking on student loan. How many of you think that this is good debt? If you guess that, you're right. And the government agrees. That's why you usually have a period of 6 months interest-free upon graduation to actually pay back the government. The government views the student loans as an investment in your education and future, eventually leading to greater opportunities for jobs or you opening a business that will help you pay off your loans. Nonetheless, it is still recommended that once this interest-free period is over, that you pay off this loan as soon as possible. Now remember, every dollar spent paying off your interest expense is opportunity lost for something you could have spent elsewhere. Now the next type of loan that you may already have experience with or probably will experience in the next 5 to 10 years is the mortgage. A mortgage is a loan used to pay off a house or residential property where you know the payment amounts up front. You know the interest rate that you're paying, either variable or fixed, which means that variable changes with the market rates and fixed is an agreed upon rate for a prescribed period of time with the bank. What do you think a mortgage debt is considered? Is that good debt or bad debt? Actually, it's good debt. In most cases, its value will increase over time and you can recoup that value later by either renting or selling it. What about a car loan? borrowing to purchase a car is actually a different story. I know that we consider a car a necessity. Maybe you need it to get to work, to get to school, or get home. However, if you find that your car loan monthly amounts are eating up a larger proportion of your income, you should note that the value of a car depreciates the moment it's driven off the lot. So in fact, spending too much money on a car loan, you can see that the value decreases over time, and that's why it's considered bad debt. The next type of debt type I'd like to talk to you about is a line of credit. Does anybody know what a line of credit is? Well, a line of credit works similar to a credit card in that the bank will give you a credit limit and you only pay the interest on the amount withdrawn. And usually the interest rate is lower than a credit card, so it's a cheaper source of fund because it's a lower interest rate. Some people use line of credits to cover their day-to-day expenses. They put it in their checking accounts or they use it to pay off their credit card fees. Depending on how well you utilize this debt tool, you can be building some great credit history with your financial institution and be able to negotiate a better rate over time. Which brings us to our next point. Credit ratings. What are credit ratings? This is a measurement of risk of an individual, which is really asking the question, how risky are you as a borrower? How likely are you to repay the debt that's due? And will you pay it on time? There are two main companies in Canada that provide credit reports. They're Equifax and TransUnion. You can request a report of your credit, which helps you itemize the items that are due, the different types of credit that you are utilizing, how many credit checks have been requested upon you. You might find some interesting information in there. Remember, the higher the score, the better risk you are. Credit scores are also known as the FICO score, or it's named after the Fair Isaac Corporation, an American company that provides analytics and decision-making based on your credit history. They use a really complicated algorithm to figure out your credit score, but we're just going to focus on the main components here. So the first main portion of your report discusses your payment history. Now this is really important because this is where it tells how often you pay your bills on time or are you late. The second component looks at your debt to credit ratio. What this means is for example, if your credit limit on your credit card is set at $5,000 a month, are you maxing out at $5,000 every month? That might not be as safe for them than, let's say, if you were only utilizing $1,000 out of their $5,000 credit limit. Next, they look at how long you've been using your credit for. What that means is, if you've been using your credit and you're deemed as reliable, hopefully you're building up goodwill with the financial institution, which will lead you to be able to borrow money at a more favorable rate in the future. That's why it's actually a good idea to start using credit cards carefully at a young age. Finally, they look at what types of credit you have and how many new credits you've applied for. They prefer people who use different types of credit instead of just one. If you've opened up several credit cards at the same time or requested for credit checks all at the same time, this may temporarily lower your score depending on circumstances. Now that we've talked about the different types of debt, let's step back for a minute and ask ourselves, what's the whole point of this presentation? Well, that's where I'd like you to refer to the handout, Defining Your Financial Goals. The whole point of this exercise is to really help you to think about your financial goals and what you want to achieve in a short and long-term time horizon. On this handout, you will see on the left side, short-term goals are defined as anything you'd like to achieve within 6 months to a year, and long-term goals are defined as anything that you'd like to accomplish within 1 to 5 years. Beside each of these goals, I'd like you to write down the expected costs that you think it will take you to achieve them. Some examples would be, upon graduation, do you expect to go on vacation? Do you expect to buy a new car? Do you have to finance your own tuition next semester? Those would be all considered short-term goals that I'd like you to put down on your worksheet. Long-term goals, do you want to buy a new car as well? That could be a long-term goal as well. Or buy your first condo. Whatever you think that you want to achieve as your dream, this is the time to really put pen to paper and really think about how to create a plan to achieve those dreams. Robert F. Kennedy once said, "There are those who look at things the way they are and ask why. I dream of things that never were and ask why not." Making the right financial choices now will enable you to achieve your goals later on and to afford the things that you want to do. At this moment, I'd like you to take out your handout, take a situational selfie. This exercise is split up in 3 components. The first component is to ask you to identify all the sources of income that you expect. So for example, if you're working a part-time job, if you are withdrawing from RESP, if you have a scholarship or grant, put down all those ways that you make money on a weekly, monthly, and then an annual basis. The second section asks you to list down all your expenses by category and then in a weekly, monthly, and then an annual basis. The third section is where it matters the most. We want to see how much you end up saving between your income and your expense. The bottom line is, if you end up with a negative score, that means you're spending way more than you're earning. You either need to make more money or spend less, and then vice versa. If your budget is a positive number, you are on track, so keep it up, and you'll be one step closer to your financial goals. The last part of our presentation will go through some tips on how to take control of your finances before they take control of you. The first tip is avoid borrowing as much as possible. As we mentioned, every dollar spent towards paying off interest expense is an opportunity cost that you could have spent for money on something else that you valued more. The second item, easy, pay in cash. I know it seems tempting and almost too easy to just make a purchase with the swipe of a card. However, studies show that people actually have more difficulty parting with physical cash. And so for that reason, if you'd like to budget what you spend on a weekly basis and really control your spending habits, why don't you practice this? Just put $100 in your wallet, consider that your budget for the week, and if you run out of your money before the end of the week, well, unfortunately, that's just frozen dinners and Netflix for the rest of the weekend. Another tip you could think about is just using a debit card. A debit card connects directly to your bank account. You can only use up the amount of money that you actually have, so you won't be overspending. Similarly, you might consider using prepaid credit cards. The bottom line is just don't spend more than you earn. A lot of our purchase behaviors are in fact psychologically motivated. We should be practicing patience and asking ourselves, do I really need this now? Do I really need this at all? We all should exercise self-discipline and only buy things you can afford. Delaying a purchase not only gives you time to save, but it will also give you more time to think about, do you really need this purchase? In fact, delayed gratification will lead to greater satisfaction for the item you've been waiting so long for. Bottom line is, you need to change your habits to save money. And at this point, I'd like you to pick up the handout called Balancing Your Budget. This exercise is meant to help you take a look at where you're spending your money on a daily basis and what that really means when you forecast it on a weekly and annual time horizon. So if you're buying 2 coffees a day from Tim Hortons on a daily basis, that's about $3 a day. On a weekly basis, that will cost you $15. On an annual basis, let's use 50 weeks for example, that's a whopping $750. Can you imagine the cost savings if you could just convert your current habit into perhaps brewing your own coffee? $750 could be a ticket to Europe. Spending less than you earn is the key to financial success. Why don't you go through the expenses that you're spending on a daily habit and see where you can cut out some unnecessary expenses. By doing this exercise, you'll be able to identify some potential savings, annual savings that could help you fund other things that you value even more. The last couple tips I'll leave you with is, if you do decide to take on debt, do your research. Because lending money is so profitable for the lender, there's lots of competition for your business. When you're shopping around, make sure you're clear about how long the grace period is, what the interest rate is, if there's annual fees for your credit cards. Make sure that the points that you're collecting on your credit card, for example, are aligned to the things that you care about. So is that for travel? Is that for products? Or do they have really awesome benefits such as access to the latest concerts, etc.? Are you buying a lot of expensive products that need extended warranty? Are you traveling a lot that you might need travel insurance? A lot of these benefits do come with the credit card, but you won't know until you ask. Remember, little things add up. Every dollar saved is $1 spent elsewhere. Thank you very much for your time. At this point, we're at the conclusion of our presentation, and I know we've covered a lot of ground up till now. So if you would like more details about what we discussed today, I've left you a list of resources available for your reference. You can also go to cpacanada.ca/financial literacy for more information about this session and any other sessions you might be interested about. Thanks very much, and at this point, I'll leave it up to the floor for any questions you might have.